Don't let the lights go out. Hello. How's it going? I figured GME would get people going. 7 out of 10 on the singing. Well, I wasn't really trying there. I've been rated a 9 out of 10 for certain songs before, so just let that sink in. GME. Wow. There's a lot of interest in GME and AMC. I've been buying April puts on all GME and AMC. So let's go ahead. Let's take a look at, I actually haven't looked at GME option prices today. But first of all, this is the chart. And so absolutely absurd. This, you want to know my opinion of this GME move is that it's a complete joke. I think the stock market is a complete joke right now. It's extremely speculative. It's always speculative, but like this is just another level. So if we look at where was GME a month ago? Today is the 27th. Let's see. December 27th. So GME was at $20 a month ago. And now it's at $320. So it's gone up 15 times in a month, which the business fundamentals have not gone up 15 times in a month. So that's just, let's see here. What are people saying? So to show you guys, actually, I did have a position in GME a while ago. Let's see here. I have to go back. GME. All right, I got to go back further. March. So this will depress everybody. So in March of 2020, I purchased 15 of the 10 strike calls in GME for 75 cents each. And that was in the January 2022 expiration cycle. Then I later closed them I sold some of them for about 100% profit because GME was kind of trickling upwards, and I did not expect it to go to $300. But then I closed the final portion of it for $2.75. So had I held this position, I would have 15 of the 10 strike calls, which would be 30 grand each right now. So that'd be, you do the math. 6-figure trade. But I'm not mad about it. I made the best decision that I could in the moment. I did not expect GME to go from $20 to $300, let alone get to $30. So yes, I understand that it's a short squeeze. Or were you talking about somebody else in the chat? So for those who don't know, a short squeeze is when there is a high short interest in a stock, meaning that there's a lot of people betting against it, meaning they take a short position in the shares, in which case they lose money when the stock price goes up. And since they start to lose money as the stock price continues to go up, the way that they have to close their position is to buy the shares. And so buying shares as it's going up, that adds to the upward price pressure. And it's sort of this positive feedback loop where the shorts are starting to lose more and more money, and then they have to buy to either reduce their position or close it. And then that added buying pressure as it's continuing to go up, it does not help the stock at all. Well, it helps the stock obviously go up, but it does not help the shorts. And so you have a lot of that going on because GME is one of the most heavily bet against stocks. And so that's explaining what's going on right now. Now, given that, Yeah, gamma squeeze too. So if people are coming out and buying massive amounts of call options in GME, the dealers who take the other side of that will have short gamma and short delta. So as GME goes up, the short delta position of their option will increase. And one of the ways they can hedge that is to buy shares to offset their increasing short delta position, and buying shares to hedge that short call position. That is going to also add to the price pressure. And so Trapped Under Ice says this won't last. Get all you can now. So it's an interesting thing because like this is not sustainable, but at the same time, I'm not trying to play this. Like I'm not trying to short GME. Let's see if there's, yeah. So the current borrow rate at Tastyworks is 50%, which basically means if you short the stock, you have to pay a 50% interest over the time period that you short the stock on whatever your borrowing cost is. So it's expensive to do it. You essentially need GME to come down heavily to offset the margin interest or the short interest that you'll pay. Should we sell some puts? I would not sell puts. Let's go ahead and I haven't looked at the option prices, but they're insane, obviously. So if you go to, this is why it's not easy. What I just said before was I don't think this is sustainable at all. And I think we can all agree that it's very likely that GME is going to collapse to lower levels. Like this stock price going from $20 to $300 in a month, that's not attached to the business fundamentals. This is attached to trading activity in the stock. And so even though we understand that there's a high probability that GME crashes from here, whatever that means, if it goes from 300 to 200 or 300 to 100, it's not an easy trade by any means. I just showed you the borrowing cost for shorting shares, which is 50%, which is an insanely high interest rate to pay when you're shorting shares of stock. Or you could do something like buying a put. But let's look at the put prices. If I go to the February 2021 expiration, which only has 23 days to go, if we look at the 200 put, so the 200 strike put, this is trading for $85, okay? And what this means is that if I buy this 200 strike put for $85, let me just change that to 85, make this really easy. If I buy the 200 strike put for $85, my break-even price is $115, which means for this put to be worth $85 at expiration, GME has to be at or below $115 per share. And so what that means is over the next 23 days, if I purchase this put and GME is above 115 when this put expires, then I will lose money. So GME has to go from 300 to 115 in 23 days for this put option to be profitable. And so if you want to get short GME and you want to do it with the put option, you have to ask yourself, is it reasonable to think that GME will go from 300 to less than 115 if I want to buy this 200 put? And also, is it worth risking $8,500 to make that play? Because if GME goes to, let's just say $100 over the next 23 days, then you'll only make $15 or $1,500 on this put purchase, because if GME goes to 100 and it's at 100 in 23 days, then this 200 put will be worth $100, which is the difference between the strike price and the stock price, or estimated stock price of 100. But since you paid $85 for it, you only made $15 or $1,500 in profits. So you have to ask yourself, is it worth it for me to put $8,500 on the line to potentially make $15 if GME falls 66% from here over the next 23 days? And in my head, it's not worth it. It's not something I'm going to do. And so even though we might look at this stock price and say, oh, it's easily going to come down, it doesn't necessarily mean that it's worth it to trade that assumption. And so that's something that I've learned a lot over the past few years, is that you don't necessarily have to trade everything, even if you have a pretty strong conviction. In this case, the numbers just don't really work out for me. But like I said, you could structure this a different way. Like you could do a put spread, but still it's really not, the numbers just aren't there for me personally. Why not sell puts? So we talked about why buying puts could be a problematic thing. Well, on the other side, if you sold one of these put options, is it really worth it to take that risk? Like what if you sell the 150 put for $5,000 and then it turns out that GME ends up back at $50 or $20 at the end of this 23-day period? What if this completely blows up? Well, then you collected $5,000, and if it goes to $50, well, now you're down $5,000 on this put that you sold. So it's a tricky, really, really tricky trade. One thing you could do, I mean, it's always difficult because you're going to have to make a specific prediction as to what you think is going to happen. You could make a implied volatility related trade, meaning that you're not really playing for a big directional movement, although we're going to get some just based on how much it's been moving. But you could make a trade based on some sort of prediction along the lines of you think the option prices will get cheaper. So one thing you could do was, let's just say, like if you sold the 300 straddle right now in February, you're collecting $300, which is insane. So this is actually more interesting to me than buying a put, betting for it to collapse, because if you sell this straddle, and I'm not really sure if you could get filled here. Let's just look at the volume. So the volume is here today, but it's still, I don't know. I'm not sure what you could get filled in this for, but this is a much more interesting play to me, because if you sell this straddle for $300, then your break-even price is the strike price of 300 plus or minus this credit right here. So if we collect $290, the lower break-even would be $10, and then the upper break-even would be $590. So this is actually a much more interesting play to me, because if I sell this straddle and GME falls a little bit and the IV also comes down, which it likely will once the stock price stops moving around this much every day, then you could make a really good amount of money on the straddle. But it completely depends on where the stock price goes. Personally, I don't like, I actually am enticed to trade this, but I don't think I will. All right, let's go through some questions here. Buy a leap put on GME. See, let's look at the leap puts. So the long term. Yeah, see, I mean, they're super, super expensive. There's not a lot of activity in the puts or the leaps for that matter. So what is AMC doing? AMC's up $13. I actually did get into this today. What I did today is I purchased some of the... this is a complete gamble. Today I purchased 3 of the January 700 days to go, and I went to the 12 strike. And my reasoning for that is, if we look at the January 2023 12 calls, these are trading for $13.50. If I go to February, the highest strike I can trade is the 9 strike. And if we go to, I mean, they need to open up more strikes. And the reason this is happening is because AMC was $5 yesterday and now it's $18. And no YOLO on this channel. Thumbs down. It's fine. I as long as I'm coming out saying this is a complete gamble, it's fine. I understand what I'm doing, and the position size doesn't really even matter. But I like to play the game too. So the reason I went to the January 2023 is because if I go to these shorter term expirations, the highest strike I can get is the 9 strike, and I can buy a 23-day call for $12.50, or I can get a longer term call for basically the same price. And so that's why I went to the longer term. I did it very quickly too. I'm sure there's There's benefits to going shorter term because you have more exposure to gamma, but like if AMC were to explode, it wouldn't really matter because these calls will be deep in the money. OS Fuentes, you're talking about open interest. I think you're referring to the puts in GME in the long-term cycle. So if we look at the open interest and the volume in GME and we go to the 700-day options, we can see that there's really not much going on here. So that's something I typically avoid. Sometimes I break the rules just because I want to get into something, even if it's a little bit illiquid, which is what I did in MicroStrategy. But yeah, I'm playing the game in AMC. I'm going to see what happens. If I lose 100% of that premium that I paid, like it wouldn't matter. I understand the game I'm playing, and this is a interesting point to talk about when you talk about options trading, is that as long as you understand what game you're playing, then you can do whatever you want. Like, I understand the trade I made in here is a complete gamble. I don't know AMC's business. I don't know how high this stock can go, but given what we've seen recently, I'm putting some money on the table to just go for it. And that's fine. How would I trade AMC? Well, I did this morning. I purchased call options in AMC, and I purchased 3 of the 12 strike call options in this longer term expiration cycle. And that was just because the pricing relative to what I could get in a shorter term expiration is very similar. So I went to the longer term and I bought a couple of these, the highest strike I could find. Ideally, there would be higher strike prices open that I could pay less premium for, but buy a higher number of contracts. But since AMC has gone up $13 today, meaning it was $5 yesterday, they have to list more strike prices. So over the next few days, they will list more strike prices so that we can actually trade like the 20 strike, the 30 strike, the 40 strike, and so on. So there's going to be a lot of activity in those options as soon as they list them. So watch out for that. Robert Ramirez asks, is there a quick answer for executing a call versus selling the call? About 400% in the money at the moment. So whenever you're talking about exercising an option versus selling it, typically there is always a benefit in just selling it, because if there's a lot of extrinsic value in the call option, when you exercise it, you're going to lose the extrinsic value, because when you exercise an option, you really only get the intrinsic value. So an example would be, let's go to Apple. So if I open up one of these columns to EXT, we can see extrinsic value. If we go to the 130 call in Apple's at 142.70. So this 130 call is worth $17.15. The intrinsic value of this call option is the stock price minus 130, which gives us intrinsic value of $12.60. So basically, if I own the 130 call and I exercise it, I'm only really going to capture $12.60 of value, because I will effectively give up my 130 call. I will just push it aside, but in exchange, I will purchase 100 shares of Apple at 130 per share. And with Apple at 142.50, I will effectively have a $12.50 profit per share. However, if I give up a $17 option for that $12.50 gain, it doesn't really make sense. So if I really wanted 100 shares of Apple and I also owned this call option and I was thinking maybe I should just exercise this call, actually it would make more sense for me to sell this call option, collect the $1,700 as opposed to burning the extrinsic value in it, which is about $500. And I would just sell the call option and then buy 100 shares directly in the open market. So typically when you're thinking about exercising an option, in most cases, especially if the option has lots of extrinsic value. It's better to sell the option and then buy or sell the corresponding amount of shares, depending on if you owned a call or owned a put, and then how many contracts you owned. Robert Ramirez, makes great sense. Perfect. Glad I could clear that up for you. There are certain scenarios where exercising an option actually does make sense, but if it's before expiration and there's lots of extrinsic value in the option, you don't want to exercise it. Just sell the option and then buy the shares. Lonely Desert Boy asks, do you like to ride or die when you buy an option, or do you set a stop loss at the market / a limit? So when I buy options, typically I go into it with the mindset of, if I lose 100% of this option's value, I'm okay with that. And so I don't really set stop losses, and I don't like the idea of it, just because, especially with a call purchase or an option purchase, the more money you lose on that option, the less you have to lose. And so if I buy an option for $1,000 and its price falls $750, and now I've lost $750 of the possible $1,000, I've already lost most of what I can already lose. And so it makes sense to continue holding it, because I've already lost 75% of the max loss, and I still have everything left to gain if there is lots of time until expiration and the stock price can still move. And so that's how I look at it with option purchases, and that's a big benefit of it, is the more you lose, the less it makes sense to close it out for a loss. But if you're sizing it up and you can't afford to lose 100% of the premium, then I would definitely look to implement some sort of stop loss strategy, or have better entries, time your entries better, whatever that means. You have to figure out your own system. Buy GME. What's the deal with Bitcoin? Buy Bitcoin. When anyone asks me these days where they should put their money, I say Bitcoin, because you can participate in stuff like this, which is just pure speculation and market mechanics. And I mean, or you can participate in something like this. I mean, you could just go to the market index, you could buy that. But these days, if you don't have any exposure to Bitcoin and you're thinking of where you should put your money, it's a no-brainer. Bitcoin for sure. How long do you think these squeezes will last? I have no idea. I would be surprised to see this persist. Like, to see GME stay up at $300 per share, or even continue to go higher over multiple weeks or months, that just seems unlikely. I think typically these things fizzle out pretty quickly, but I can't tell the future, so I have no idea. But I would guess that this does not last very long. So a couple of weeks. Hi, are you long on GME? I am not long GME. I went through a position that I had earlier. I did own call options in GME back when it was at $5 a share, and I had some of the 10 strike calls, and I sold those for 100% profit, and then I sold the last 5 of the 15 contracts. I closed those for about $3. So I made good profits on that position, but I obviously didn't think that GME was going to go up to $20, $30, $300. When I got out of my GME call options, GME was at like $10, I think. What do you think of buying MicroStrategy, MSTR, Leaps calls? I like it, and I do own exactly those. This is my MicroStrategy position. So 2 months ago, I purchased the 330, 400 call spreads, and my play with this was I was going to close out the short 400 calls if if MicroStrategy collapsed from where it was. But what happened was it actually continued to surge higher. And then I did purchase a 500 strike call in the December 2022 or 2021 expiration cycle. And I bought that for $8,000. Now it's at 20, so that's going pretty well. This stock, so for those of you who don't know, MicroStrategy was the first publicly traded company to come out and say that they were putting money into Bitcoin. So they took all the cash that was on their balance sheet and they put it into Bitcoin. So they purchased like $500 million of Bitcoin. And this was back when Bitcoin was at 10, 15,000. And so this stock is essentially a proxy for Bitcoin. If Bitcoin continues to go up, then MicroStrategy is going to go up as well. And so that's why owning call options in this stock will do very well if Bitcoin continues to surge. But it's going to be the same thing. It's going to be the opposite on the other side of things. If Bitcoin collapses from here, then since MicroStrategy owns so much Bitcoin and the value of this company is tied to Bitcoin, then the stock price will fall as well. So if you can't get any direct exposure to Bitcoin for whatever reason, or you just have like an IRA where you can't invest in Bitcoin and you want your IRA to have exposure to Bitcoin, then you could purchase shares of MicroStrategy, or you could purchase long dated call options. You can also invest in Square, because Square actually also came out and put money from their balance sheet into Bitcoin, but much smaller than what MicroStrategy did. If we go to MicroStrategy and we look at the current leaps, the stock is at 535. Let me just wait for these to load. So as you can see here, there's a lot of interest in upside call options on MicroStrategy. So if you go 2 years out, the stock price is currently 535. If we go to the 800 strike, these are trading for $20,000 a piece. So this is not cheap by any means. What you could do to make it a little bit more accessible is you could purchase the 600, 700 call spread. So this would give you $2,000 of risk, $8,000 of profit potential, but you'll essentially need MicroStrategy to breach through these strike prices, and you'll need time to pass as well before you get anywhere close to that maximum profit potential. So, and you might be wondering, would you trade these options because they don't really have a lot of activity? And if you're looking at the open interest here, it's really, really thin. There's no volume. And yeah, you can trade these. I did trade these. Like if you look at my position, my strike prices here, they don't have that much open interest. And I did trade a liquid options here, but this is a special case where I wanted the exposure and it didn't matter to me that there was very low liquidity in it, because this is not something I'm trading in and out of. This is something I'm entering and then I'm holding it for many months. And then right now I could get out of these options and I could book a huge profit. I'm not going to do that right now, but this just goes to show that even if there are illiquid options, it's okay to trade them. It just has to be a very special case. Like you don't want to do most of your trading in a stock like this that does not have any option liquidity. It's a very special case. Do I think GME will go above 1,000? I don't think so. I do not think so. Let's see here. Someone asked about strike prices. They said, why do you not see any strike prices above 320 for GME? Back when I was talking about AMC, I talked about how they only have strike prices up to 12, but AMC is at $18 a share. The reason GME does not have options listed above 320 is because if we look at the stock price here, GME is 330 today. Yesterday it was $180 cheaper. Okay? So since the stock price increased so much overnight, there are no listed options for these strike prices. So what's going to happen is over the next few days, they're going to list more and more strike prices above 320, and then traders are going to start piling into those as well. And so whenever a stock has a massive movement upwards, typically if it exceeds the previously highest listed strikes, then you're not going to be able to trade at the money strike prices or even strike prices that are above the stock price because they have to list more options. SPC. Virgin Galactic. Yeah, Virgin Galactic is the reason I'm making money today. So in Virgin Galactic, let's see, 190 days ago, what is that, 6 months? So 6 months ago, I purchased the January 2022 60 strike calls, and I paid $4 each, so $400 in premium for each of these, times 10 contracts is $4,000. Now they're at $2,000 a piece, so this position is up $16,000. However, I can't really do anything to adjust this. Earlier I was looking at this. You may be familiar with how I traded Tesla, which is I purchased call options, and then after Tesla shot up, I shorted higher strike call options to significantly reduce my risk on the initial call purchase. And I wanted to do that here, but we're experiencing the same thing where there are no strike prices that are listed at higher strikes than 65. And so 60 is the strike that I own. Ideally, I would want to go to like the 90 or 100 strike or whatever calls are trading for approximately $5. And then if I sell or short 10 of those calls at a higher strike for $500 each, then I will effectively turn this into a risk-free trade. And the only thing I could lose would be the unrealized profits. Do I think GME and AMC will be suspended for exchange investigation? I'm not sure. What if we sell far out of the money options? Can it give a stable income? So this is one of the things that new options traders get into, is the idea that you can short options. If we go to SPY, this is a very common product to do this in, which is just the S&P 500 ETF. If we look at out of the money options in SPY, let's say we go to the, let's see here. If we go to the 340 strike, you can sell the 340 puts for $600 each. So if you sell the 340 put and in 50 days SPY is above 340, you keep $600. And so since this is a high probability strategy and most months it will work out, traders will call this an income strategy, because you can put on a position like this and make money most months, and you have a high probability of doing so. And that's why they call it an income strategy, because you can basically repeat this every single month, and most of the time you'll have money coming in. However, you have to watch out for the big loss. So whenever you're selling put options or you're selling naked options, you're going to make money most of the time, because it's a high probability strategy. Because in this case, SPY just has to stay above 340 over the next 50 days and this trade will make money. But what you have to watch out for is, if you can make $600 on this, what if you have one big loss, as you would have last March when the market crashed, and then you have a loss of $5,000 on one contract? Well, on your winning months, you made $600 per contract, but then in March of 2020, you lost $5,000. And so where does that leave you? Well, you have to make these $600 profits, and you have to do that a handful of times, almost 10 times, to get back your $5,000 loss. And that can be a little bit uneasing psychologically, because you have all these small wins and then you have a massive loss, and then you kind of have to dig yourself out. And so with these types of income-based trades where you're selling options and you have a high probability of making money, the number one piece that you need is you need some sort of loss mitigation strategy, meaning some sort of stop loss or sort of hedging strategy, because you just can't leave it up to chance to have that catastrophic loss. And there have been examples where people had great success selling put options in the index products, and then all you need is that one huge loss to completely wipe you out. And that's especially true if you're selling way out of the money options where 99% of the time you're going to make a lot of money, or not a lot of money, 99% of the time you're going to make money, but as soon as you get that March of 2020 move, you just got wiped out. And so you have to be careful with the strategies that seem too good to be true. And with income-based option selling, you have to have some sort of loss strategy. You have to be taking losses somewhere. So I don't like selling puts. I don't hate it, but for the reasons I've mentioned, I don't think it's as strong of a play as some might believe it to be. Another thing with selling puts to consider is people will say, I'm going to sell puts because I want to buy shares of this stock. And by selling puts, I can collect money, and eventually, when I'm assigned on that put because the stock price is below the strike price when the put option expires, at that point I will buy 100 shares and I will have kept all the premium that I received and saw those profits come in the trades that were not assigned. And so people will say selling puts is a way to get paid while you wait to buy a stock. But what you have to think of is when you sell a put, you have limited profit potential, right? So what if last year I wanted to sell puts in Tesla because I wanted to get paid while I waited to buy the stock? Well, what if I never bought the stock? Well, I made a couple $1,000s here from the put premiums that I saw go out worthless. But if I would have just purchased 100 shares, that would have made way more money than selling puts. And so that's kind of the problem I have with selling puts, is that it's framed as a way to get paid while waiting to buy stock. But if you really believe in that stock and you want to buy it and own it long term, then you should just buy the stock, because the profitability on that long stock position is going to far outweigh the profitability that you could get from having a couple profitable short put trades. Let's see here. Alistair, how about selling extremely out of the money calls as an income strategy? Do you mean selling naked calls, or are you talking about selling covered calls? So do you own the shares and you're selling the calls, or are you just selling the calls? Same thing kind of goes for covered calls. A covered call and a short put are effectively the same strategy, synthetically. So I'll show you what I mean by that. Let's go to, where do I want to do this? Let's go to Facebook. All right, let's compare two things. So we're going to compare a covered call, which is buying 100 shares, and selling a call option. So if I buy 100 shares of Facebook at $271.50, let's just lock in this price so we can make it really easy. And I sell the $290 call. My maximum profit here is the difference between the strike price of $290 and my share entry price of $271.50 is where I locked it in, plus the premium for the call. So if I buy 100 shares of Facebook at $271.50 and I short the $290 call, what I'm basically doing is I'm selling this call option and I'm collecting this premium of $750, and I'm getting paid $750 to essentially cap my profitability on the shares at $290 per share. So if Facebook is at $271.50 and it goes up to $290 and I have to sell my 100 shares, I will make $1,850 on the share position alone. Plus, I will make $750 from selling this call and holding it until expiration. And so $1,850 plus $750 is approximately whatever this max profit says. Okay? Here's the thing. If we swap out the shares and the covered call position and we just look at selling the $290 put, if we sell the 290 put, the best case scenario is that we make right around 2,600. So this max profit here is the same as buying 100 shares and selling the 290 call is the same thing as just selling the 290 put. Because if Facebook is below 290, I will keep the premium that I collect here and I will buy 100 shares. And so I'll have 100 shares, much like I would if I sold the covered call and Facebook was below 290 at expiration. However, if Facebook is above 290 at expiration, then I will make the full profit of this put and I will not have shares of Facebook, right? And so if we compare the covered call to selling the put at the same strike price, they're synthetically the same position. And so when I describe how I don't really like selling puts, in the same way I don't really like selling calls, because if I own shares of a stock that I really like, I don't want to cap my upside, even if it means I can collect a few $100s here and there. How to calculate the maximum loss in an option trade. To calculate the maximum loss in an option trade, you calculate the position's maximum value minus your entry price. Well, it depends. So, all right, I'll do this here. So if we look at selling the 270, 280 call spread, the maximum width or the maximum value of this call spread at expiration is the distance between these strike prices. So if I sell the 270, 280 call spread, the most that this spread could be worth is $10. So if Facebook is above 280 at expiration, this call spread will be worth $10 or have a value of $1,000. If I sell it for $4.40 and it goes to $10, then I will lose $560. So the max loss in this case is the difference between my sale price and the position's maximum value. The maximum loss for a option purchase is just whatever you pay for it, because the most that you could lose is whatever you pay for it, since the minimum value of an option is $0. And so if I pay $2,000 for this option and it goes to zero, I lose $2,000. So maximum loss is always a position's potential value minus whatever your entry price is. And it's whatever is the most unfavorable for you. Over 1 billion shares traded today in AMC. It's insane. What's AMC doing? It's looking good. So Lonely Desert Boy says, only thing with covered calls is that the price dropping on your 100 shares, then you keep the premium, but you're down on your shares. So if you trade a covered call, you do get downside protection, because the short call will add profits to your position as the stock price falls or as the stock price remains below that short call. So if you sell the short call, if you short the call for $500 in premium and the stock price falls and now the premium of the call is $250, then you have a $250 profit on the option portion, which will somewhat buffer the losses on your share position that has fallen in value. But it will only be a partial protection. So the benefit of the covered call is you get some downside protection, but the downside of a covered call is that you limit your upside profitability, which if it's in a stock that you really like and you want to hold it long term, personally, I don't think it's worth it. Some interesting questions here. Would you hedge a position if it goes against you? And if yes, at what percentage? So it depends on... The tough thing about explaining trading is that it's situation based. There's not really a a blanket answer that I can give you. It would depend, I would say, on how large the position is and what your actual strategy with the position is. If you're trading a position and you're sizing up, like you're putting 100% of your account into a position because you want mass amounts of leverage, but you cannot afford to lose that position's max value, then I would say yes. If the position goes against you, then you're going to want to start getting defensive, whatever that means, by adding positions that will profit if the stock continues to move against your initial position. So adding a hedge is adding a position that will make money when the rest of your position is losing money. So there's an offset. I would say, yeah, if you have a really large position and that's part of your strategy, then yes, you would hedge if it goes against you. But if you were trading a position where you entered it with the mindset of, I can lose 100% of this position because its size so small, then I would say hedging is not as important. Recently, what I've been doing is hedging positions that have been going in my favor, such as Tesla, because Tesla's gone up so much, and I've had all these long dated call options here and call spreads that have done very, very well for the position. But as the position has grown, I have added hedges to the position in the form of long puts or turning the naked call options into spreads, as I did here, just to reduce the directionality of it, reduce my positive exposure, and also reduce my potential loss that I could experience if things were to turn around. So I think for me, hedging is more so important when I'm trading positions that have done really, really well for me, because I don't want to see those positions going back to their starting values and then seeing all of my profits up to that point get erased. But like I said, it really depends on what you're trading, how big you're trading. But I would say my final answer is, if you're trading a position that's super small and you go into it with the mindset of, I can lose 100% of this position's max loss, then I would say you don't necessarily need to hedge if it goes against you. I actually, in general, I have more of a philosophy of close your bad trades and then just re-enter, look for the next trade, as opposed to trying to fix trades that have gone against you. Let's see here. Take profits on AMC or hold until tomorrow. What's your position? How short term is your position? If your position is super short term, meaning your options are expiring very soon, then you're in a position where if AMC goes down $10 tomorrow, then all of your profits are going to be gone. And there's not going to be much time left for you to actually really react. Whereas if you have a longer term position, it's a little bit less sensitive to changes in the stock price. So, and it really depends on what your intention for the trade is. My intention for this trade is I'm not looking for a quick few $100 profit. If we go to AMC, currently up $1,000 on it, but it doesn't really matter. But like for this AMC position, I'm not going for a quick hit. I want to see if AMC explodes like GME did. And that is when I'll start thinking about taking profits. Yeah. Let's go. What's up, Nathan? One of my college suite mates just dropped in this chat. I had no idea that he watched my channel or even knew about my channel. What's up, Nathan, man? It's been a while. Let's go. He said he made $4,000 on a GME YOLO he did 2 weeks ago. It makes me happy. Michael Ryan says, can you explain what happens when new strikes are added to a stock? That's a good question. So if we look at if we look at AMC right here and we look at February 2021 options, this is typically the most active expiration cycle, is the monthly expiration that is expiring is basically what we call the front month. So since January is already passed and January monthly expiration is already expired, that means that the next front month expiration is February 2021. And so if we look at AMC, the stock price is at $18, but the highest strike that is listed right here is 9. And so what's going to happen is there's going to be more strikes listed for AMC, and then the market is going to start trading those options. And at first, it's going to be a pretty chaotic process, but after participants start going in and all the institutions start trading it, then the options will kind of find their price. But if you're trading a newly listed option on the first day that it's listed and you're doing it right at the opening bell, chances are the bid-ask spreads are going to be pretty insane. So basically what happens is that they just add new strikes to be traded, and then the market starts trading them. And then after buyers and sellers step in, and a few thousand of them do, then the options they'll find their price. Made 10 million in GameStop. Yeah, that was insane. The one dude in Wall Street Bets who made 10 million. Although Wall Street Bets is a very dangerous thing because you see the success stories and you see the people that are making tons of money, but for each person that makes a ton of money with these long shot trades, there are hundreds or thousands of other people who are losing large sums of money, which is unfortunate. So it's fun to watch the headlines and watch the stories, but don't let that fool you into thinking that it's easy. Virgin Galactic has more short float than GME. Get in before we lift off. Let's do it. Simon, I do have a position in there in Virgin Galactic, which I talked about earlier today. I wanted to add a hedge to this position, but I'm not going to do it right now just because I want more strike prices listed so that I can turn this into a call spread is what I want to do. But since my strike price is 60, I'm not going to sell the 65 call and turn it into a $5 wide spread. That would essentially be the same thing as just selling the 10 options and just getting out. What I want to do is see more strikes open up, and then I'll turn it into a spread. But yes, I hope Virgin Galactic lifts off. Be very fitting for the company as they are a space company. Other Chris from ASU here. What's up? Chris who? What's your last name? Sorry. Oh, wait. Sorry, I got confused. We'll have to catch up off of the live stream. Play some PUBG or something. Yeah, I got it. Sorry, I got confused. Because you know my other roommate, Chris. High strike price. Yes, this is a great question. Hi, Chris. Can I buy back the high strike price leg on a bull call spread when the market is down? Yes, you can. Let me see if I can give an example. I mean, I don't really have... All of my spreads are profitable, so it's kind of hard to demonstrate. But what they're saying is, can you trade? So a bull call spread is when you buy a call and then you short another call at a higher strike price. And so you have these two different components for your trade. And when the market goes up, the call option that you purchased is going to make money because its value will increase, but the short call option will also increase in value and you will lose money on the short call. So when the market goes up, You'll make money on your lower strike call. You'll lose money on your higher strike call. But what this person is asking is, if you buy a call spread and the market goes down, you'll have lost money on the call that you purchased, but you'll have made money on the call that you shorted. And so what you could do is you could buy back the short call for a profit, and then you'll still have the long call. And then if the market goes back up, then you could resell the higher strike call. And effectively, you'll have traded in and out of that call, and you'll be better off for doing the trade in and out as opposed to just holding it the whole time. But that's a more speculative maneuver, because if you keep the short call and the market continues going down, then it'll reduce your losses on the call that you own. But if you buy it back and then the stock goes back up, then you'll make a lot more money on that trade overall. So it's a much more predictive maneuver, but it's something you can definitely do. And that was my intention with the MicroStrategy call spread that I purchased here. So I purchased a 330-400 call spread, and I bought this into a rally. So when I bought this, MicroStrategy was right here. So it had already gone from 160 to 330, and then it kind of fell back a little bit. And that's when I bought this 330-400 call spread. And my intention was, if it goes up, I'll make money on the call spread. But if it collapses, then I will buy back the short calls for a profit, and then I will just hang on to the long calls because they still have a year plus to go or whatever it is. So that was my intention with the MicroStrategy call spreads that I purchased. But fortunately, the stock price just went up, and I made a profit on both of these. So if we look at it, currently the profit is $7,500. But this is a $70 wide call spread that is currently valued at $32. And so this can still increase by $3,800 per spread. So I can still make a really good amount of money if MicroStrategy stays above 400 and as time passes and all of the extrinsic value comes out of the spread. Because with MicroStrategy above 400, the 330-400 call spreads will steadily approach their maximum value of $70 as time passes. I love all the short squeeze answers. Is GME, people are asking, is GME or is Virgin Galactic the next GME? Virgin Galactic's kind of already it's already been exhibiting these types of behaviors. This is not the first spike. If we look back, it had a big spike and then it completely crashed. So this is a very similar thing. This shape is what I'm expecting from GME right here. Massive surge from $5 to $45 or whatever, and then it went all the way back down. This is what I'm expecting from GME, but I'm not sure over what time frame that'll play out. But as we described earlier, GME business fundamentals have not gone up 15x in a month, but the stock price has, so take that for what it is. But I think here's what's going on. Since everybody has seen what's happened with GME, now everybody is thinking that it'll happen again with these other heavily shorted stocks. So that's why AMC is surging. I think that also has to do with Virgin Galactic. So basically, GME is setting the stage for what could happen, and people are piling into these other stocks, anticipating that something similar could happen in these other stocks. But it most likely will not be as exaggerated as it was in GME. But that's essentially what's happening. Nothing is the next GME. You're probably, yeah, I think you're right. See you on the moon, boys. There you go. Let's get some good questions here. What are my thoughts on long puts in GME to my old sweet mate and friend? I described this earlier, but what I described was if we look at, I'm going to do this really quickly. GME is at 350. If I were to purchase if I purchase the 300 put, I have to pay $15,000 for it. And my break even in 23 days is going to be 300 minus 150, which is 150. And so I need GME to go from 350 to 150 just to get to my break even point over the next 23 days. And if it goes to 100, then I'll essentially make a 30% return on this put purchase. And so for me, the numbers just don't make sense because you have to pay way too much for these options. And you need GME to essentially like go back to $10 to make decent money. But if you were to buy this 300 put and GME went to 0, you would only double your money, which is typically when you make an option purchase, you want to have a better risk to reward ratio than, just doubling your money or losing 100%. You want the opportunity to make, 5x, 10x, and lose 1x. So for me, the risk to reward just doesn't make sense for buying puts in GME. Zach says, okay, well, why don't you just flip it? If you don't want to buy it, then why would you not sell it? Well, because I don't think that GME is going to stay up here, and selling a put is a bullish strategy, meaning that if I sell this put and GME collapses, like I'm going to be losing money on this position. And since I think GME is going to go down, it doesn't make sense for me to put on a bullish position. Because if I sell this put, I make 15,000. I make 100% if GME is above 300 in 23 days. But if it goes to 150, then I break even. If it goes to anything less than 150 over the next 23 days, which I think is likely, then I'll lose money on this short put. So just because I don't think buying it makes sense, it does not mean that I think selling it makes sense either. This is a scenario where I'm not doing anything. Send me your best questions. I'll answer whatever I think will be helpful to the masses. Juan says the best thing to do at an early age is establishing and invest in yourself. Work in something useful and that you like, start living well and being productive, and then invest in something you like. I agree with a lot of what you said. Always invest in yourself. That's the best investment you'll make. Learning things. Spend time learning things that fascinate you and that don't feel like a chore to you. That's going to be your best investment. And working in something you like, you have to work in a lot of things that you don't like before usually you find what you do like. But the thing about even working in something that you do like is maybe you realize, all right, I don't like this. I thought I would, but then I don't like this. But then also you might encounter things that you never even really thought of before, and maybe you stumble into your true passion. Just a little life wisdom side note. Everyone's talking about NOK. What is NOK? Nokia, that's what I thought. Oh, man. I don't... This is so funny. See, all these stocks everything is reacting to GME. Like, everyone's betting on what's the next GME, but as someone pointed out, I don't think there is a next GME. SPX down 100 points today. That is correct. It's a big one. Tesla earnings after the bell today. Everyone watch out for that. At least I think they are. 27th after the bell. Do you trade earnings plays? No, not really. I don't really like trading earnings. I think earnings are pretty much gambling. And I don't know. I just don't really like the whole earnings thing because you either hit or you don't, and there's nothing you can really do about it. It's very binary. So you either make money or you lose money, and you typically do one of those two things very quickly. There's not really a lot of in between. There's no way to manage your trade. What I will say about earnings is if you are trading earnings, I would highly recommend that you do not sell naked options. So if you're trading earnings, don't sell puts or sell calls without having protection in the form of a spread. So if you're going to sell options through earnings, then I would make sure you always have spreads, even if they're super wide. I would highly advise against selling naked options through earnings, because earnings are when companies announce things that people aren't expecting. And so to go into a stock's earnings and think that the options are accurately pricing everything that they will announce, it just can't really be true. A lot of the times you will see that, yes, the stock price stays within the expected move that the options are implying, but there are also many examples of when it did not, and it completely violated the expected move. And in those types of moves, if you're shorting naked options, you're going to lose a lot of money, and it's not worth it. Let's see here. Lonely Desert Boy asks, do you ever place options trades after market close, or better to wait until market open? Well, you can't trade options after the market closes. So you can only trade options when the market is open itself. So you can't trade options after hours. Do you exit a position before earnings? It depends, but if I have a longer term position on, then no, I'm not going to close through earnings, because my longer term position, I'm going to factor in that the earnings are they're probably going to help my long-term prediction if I have a conviction in play. So an example would be Tesla. Tesla has earnings today, but I have not done anything to my Tesla position, and I will be holding everything here through Tesla's earnings. I'm not gonna do anything. However, I did purchase a protective put in the earnings cycle. So I actually forgot I did this. Yesterday, I purchased the 800 put expiring in 2 days, and I paid $6 for this. It's currently at $14, so it's up $800. This is not a position I'm trying to play for a profit. This is a position I'm playing to protect against really upsetting Tesla earnings. If we look at the January 2021 expiration, which is the nearest term weekly cycle, this is the expiration that people are trading for Tesla earnings. If we look at this number to the right here, it says plus or minus 80. This is the expected move for Tesla through this expiration cycle, or through the end of this week. So this basically tells us that through earnings, there is an expected $80 move or so in Tesla. And you can also look at the money straddle. So since Tesla's at 860, if I queue up an order for the 860 straddle in this near-term expiration, we can see that the straddle's price is $80. So that means that on the downside, if things go poorly, the market is expecting maybe Tesla falls $80. If Tesla falls $80 at this point, then it would be at 780, and then my 800 put here will be worth $20. We'll have $20 of intrinsic value, probably a little bit more considering it expires on Friday. But this is basically a protective put. So if Tesla goes down $100 or whatever, it has really upsetting earnings, then what I will do is I'll probably close out this put for a profit. And then that profit will essentially shelter some of the losses from the other portion of my Tesla position. But then I also have these longer term protective puts as well, such as the June 700 put. I have the February 650 put, which basically this one's already almost a full loss because I bought this a month ago or so, 23 days ago, and Tesla continued to go up. And so this put has lost a lot of its value. So I do have a lot of protective positions in the Tesla position just because it is the largest by far. If I sort the positions by net liquidation value, which is if I close the whole position, what is it worth? I could liquidate the Tesla position for 110K, and the next largest position would be MicroStrategy at 37. So this portfolio is highly concentrated in Tesla, and that's because the position has grown so large. It's not that I initially put the whole portfolio into Tesla, it's that the position has grown so profitable that naturally the allocation in the portfolio has grown. But I'm still holding the core components, but as you can see, I'm doing some protective stuff, as I mentioned earlier, because I don't want to see this position go belly up. And so the protective puts are more than worth it. Donald bought GameStop. That's funny. Jason asks, how can you check option prices after an overnight jump? And the answer is you can't know exactly where an option's price will be, but what you can know is if the option has intrinsic value. Okay? So let's go to Apple just as a hypothetical. And let's say Apple's actually reporting today. Okay. So let's say I buy the 150 call in Apple for earnings. So if I buy the 150 call in Apple for earnings, Apple is at 141.50. Now let's say in some crazy scenario, Apple after hours goes to 175. Now the market will be closed at this point, and I won't be able to know exactly how much the 150 call will be worth. However, based on some very fundamental option pricing laws, meaning an intrinsic value, an option will always be worth at least its intrinsic value. So if I buy this 150 call and after the close today, Apple goes to 175, then I know that this 150 call is going to be worth at least $25. Because if Apple's at 175 and the strike price of my call is 150, then that I own a call option that can buy 100 shares of Apple $25 below the current stock price of 175. And that means that this 150 call will be worth at least $25 when the market opens tomorrow if Apple's at 175. So even though the market is closed and I can't really see where the price is trading, if you know how much intrinsic value an option has, the option will have at least that. And then depending on how much time is left until expiration, you can add on a little bit of extrinsic value. But since this option will only have 1 day left until expiration as of tomorrow, if Apple goes to 175, then this option is basically going to be trading with very little extrinsic value, mostly intrinsic. And that means if Apple opened up at 175 tomorrow, I know that this 150 call will be somewhere around $25. Please talk about AMC opportunities. All right, I'll go to AMC. All right, so AMC is going up a little bit again. It's at 19. High of the day around $20. So it's trading right around the high. I would anticipate that AMC will have a big after hours move just because it's moved so much today. It's just a prediction. It could be a downside after hours move, or it could be another absurd upside movement. The problem with AMC right now is that they need to open more strike prices. And they probably will have more strikes listed tomorrow. And since AMC's at $20, they'll probably list strike prices up to like $50 or $60 or whatever, just because of how much AMC has moved. And so they'll probably list strike prices and give traders more opportunities to work with. But right now, if you wanted to trade AMC with options, you're very limited because AMC's at $19, and the highest strike price that you can trade in February is the 9 strike. And so that basically limits you to buying the 9 call if you want to do that. But then you're going to have to essentially buy a deep in the money call. And a lot of traders in these scenarios are going to want to trade out of the money options because they want lots of leverage. So right now, unfortunately, you're kind of limited just because there's not a lot of strikes open. But as they open up more strikes, there will be more opportunities and just more things you could do because you'll have more options to work with. Frankie Ward asks, would you take over a $2,000% gain with 3 months remaining on your option? With 3 months remaining, I would be very defensive in that scenario because by no means should you let that 2,000% gain go to a 0% gain. Okay, so you have to be defensive in that situation because you've 20x'd, and so anytime you do that, like it doesn't make sense to be greedy because very rarely will you get a 20x. So I would be very defensive with that, and that's all I can say. I don't know your specific position or the specific stock or your entry price, and so I can't really offer anything more than that. But whatever you do not let that 2,000% gain go to a 100% gain, 500% gain, whatever. Be very defensive with that because you're really lucky to have that gain. Hey Chris, any comments on Square? I like Square as a long-term hold. I think Square is one of those companies that they are in a position to do very well just based on kind of the way the world is going. And I also really like Square because they are one of the public companies to have come out and state that they purchased Bitcoin. So Square purchased $50 million worth of Bitcoin, I think, a few months ago. So they put 1% of their balance sheet into Bitcoin, and they're absolutely killing it with Cash App and everything. And I definitely think that Square is one stock that I personally am going to be investing money in and holding long term. Obviously, it's difficult when you look at this and you think, okay, like Square last March it was at $50 a share and now it's at $200. So obviously it's already gone up a lot, but like I said, I like Square long term, and if I happen to buy this month and the next month it's at a much lower price, well then I'm going to just invest more money next month at the lower stock price and I'm going to get more shares for my money. So that's kind of how I approach investing. A lot of my friends will text me and they'll be asking about stocks, and they'll say stuff like, I'm really interested in this stock, but I'm thinking I'm just going to wait until the next dip. And my friends even texted me that about Bitcoin. When Bitcoin went from 10K to 18,000, I had friends texting me saying, I'm going to get into Bitcoin, but I'm going to wait for the next dip. Like, what do you think? And my advice to those people has been, I wouldn't wait for the dip. I would just buy right now. And then if you're unlucky with your timing this month, then the next month when you have money to invest, then put more money into it because you'll get a higher quantity for the same amount of dollars, and just rinse and repeat that process and just believe in the long-term vision for whatever you're putting your money in. Don't be worried about, is this month the best time to get invested in this, or should I wait a month? Because what happens if you don't invest right now and then Bitcoin or Square, it goes up again and then it has its dip, but then the bottom of the next dip is actually a higher price than what you could have gotten if you just invested right now. And so that's how I approach it. What great examples, role models do you try to resemble or inspire you? And who or what were them? Was it a big ass trade? Juan, I don't really have any I don't really have any trading role models. Um, a lot of what I've learned has just been through my own experience and then learning about investing in general and kind of experiencing how my psychology works through good and bad market periods. And so I haven't really had a mentor in trading. My experience has been my number one educator. But in life in general, some role models that I have would be I'm a big fan of people who are like Tim Ferriss or Joe Rogan, people who are they're very open-minded and they're very curious about lots of different things because curiosity is a I think curiosity can do very good things for you because if you're a very curious person, then not only will you get involved in more things and then discover the things that you love to do, but also when you start learning about something, I think if you have a lot of curiosity, then when you learn it, you're going to learn very fast because you're always going to be asking different questions, or when you try to find the solution to one question, then you'll come up with a different question. And then naturally, because you're a curious person, you're not just going to let that question sit there. You're going to try to solve that question as well. And then I think you can become somewhat of an expert in whatever it is that you love to do very quickly if you're a very curious person. And so I like people who are like Tim Ferriss or Joe Rogan because they talk to people from all different walks of life and they always have very interesting conversations. They're very open-minded. They like trying new things. And so for me, that's kind of the person that I strive to be. And so those are the types of people that I look up to. Thanks for taking the time to dumb this down for us. I'm still lost though. It's okay. In these live streams I move pretty quickly and I kind of assume that you have some prior knowledge, whether it's from my videos or someone else's videos or blog posts or your own trading. I try to explain things as I would in an educational video, but not all the time in these live streams am I going super deep and explaining everything from square one. But hang in there. Options are very complex, and I've been doing this for 8 years now, full time. So since 2013, every single day, every single week, like options have been a part of my life. And so naturally, over that prolonged period of time, since I've had a lot of exposure to them, I've been able to pick up on lots of different things. And the longer you're exposed to something, the more you pick up on the intricacies that you don't necessarily pick up on right when you're a beginner. So keep your head up, keep pushing, you'll get it. I promise. Did Joe Rogan experience inspire you to shave your head? Potentially. I know Joe Rogan has a bit from his podcast when he talks about him shaving his head. For me, I like this topic because I've gotten comments before on my YouTube channel like, why would you shave your head? You're such a young guy. And well, the obvious answer should be I started balding very, very young. And I'll be 28 next month. And I've already, like, this whole section is super, super thin. And so for me, my two choices were to have grown out hair and clearly have a heavy balding pattern where it's full on the sides, but then you can see straight to my skull, even through my hair when it's grown out. So it was either that or take control of the situation because I can't control balding, and take control of the situation by shaving it. And I think that I look better with a shaved head than I do with grown out hair, and so my choice was to shave it. Are you a millionaire already? I'm not going to answer that question. I won't talk about net worth. A shaved head isn't easy to maintain. That's not true, because I have to shave this multiple times a week, ideally, and it's a kind of a time-consuming process. So even though there's no hair, there's still maintenance. Happy early birthday! Thank you. Yo, Chris, shave it. Shave your head. It's weird at first, but it'll be nice. Where to find an options trading mentor? That's a good question. It's a tough one because you got to be careful when you're searching for a mentor or someone that if you're going to pay somebody, then I think you have to be careful. But if you find someone that is very knowledgeable in options trading and they're willing to help you for free here and there, then I think that's your best bet, because I think if you pay someone, then there's this expectation that you have to have results, which that's why I don't want to do one-on-one mentoring. But the larger reason I don't want to do one-on-one mentoring is that that's not how I want to spend my time. I very much value my flexibility. And if I started booking out one-on-one sessions with lots of people, then my job would kind of become more of a 9 to 5, where I'd be tied into a schedule, and I don't like that. But I also don't want to, the things that I talk about on this live stream are what I would talk about if someone paid me to teach them trading. If any one of you paid me $100 for an hour of my time and you asked me questions, what I'm doing now is exactly what I would do with you if you were to pay me to mentor you. And so that's why I like these live streams, is that people ask questions and I can pick out the questions that I like and that I think everybody could benefit from. And then I'm basically doing one-on-one mentoring with all of you. It just doesn't feel like that because there's lots of people watching. And so it's not necessarily a one-on-one thing. And also I might not answer your question, but if you were to pay me to be your mentor, this is exactly what I would do with you and have these same exact conversations. And so I don't really want to have people pay me, because when it comes to investing in the stock market and trading, there are no guarantees, and it doesn't matter what I tell you. It doesn't mean that you're going to have a lot of success with it. The first step in learning about all this is getting to a point where you understand how everything works, you understand the mechanics and what you can expect given certain outcomes. But once you get to becoming an options master, where you understand options very, very well and how they can work for you in different scenarios, it does not guarantee that you will be able to make money every single month or with every single trade. There's always going to be risks, there's always uncertainty, and at the end of the day, you have to be right about the predictions that you're making. But the first step is learning the mechanics of how everything works, because once you know the mechanics, then you can understand where you would like to apply certain strategies. And so I know that might not be the answer that everyone wants, but that's kind of why I don't like the idea of mentoring. But how to find a mentor, you just have to find somebody that is clearly very knowledgeable about whatever it is that you need mentoring in. And then I think you kind of just have to ask them straight up, will you be my mentor? Where did you learn options trading? Anoop Baines asked, where did you learn options trading? So I started in 2013. I got an internship when I lived in Chicago. I got an internship at Tasty Trade. I worked on the Tasty Trade research team, where it was essentially my full-time job to come up with the educational segments that they did. And then after 3 years at Tasty Trade, I kind of developed my own way of thinking and I wanted to go out and create something of my own where I could just have complete freedom with my voice and the content that I created. And so then I left in 2016 to start Project Option, and then I've been doing that ever since. And so I've learned options trading through having a lot of exposure to different trading strategies and my own trading positions, and then just the markets overall over the last 8 years. So it's where I learned 95% of everything I know is through experience. And I know you'll say, some people will say, well, you worked at Tasty Trade, that makes sense. And while it helped me to work at Tasty Trade because I got to focus on this stuff full time, it is not a requirement. You can learn this stuff. You just have to put in the time, and you have to be patient with it too, because like I said, I've been doing this for 8 years. And if you're just getting into it, you're not going to learn everything in a couple months. It's going to take a very long time of ironing a lot of details out and getting a lot of experience on your own. Experience is the number one educator in everything. Like, you could watch all of my options trading videos, but it's still not going to be as good of an educator as your own experience. Fraser said, no, that's his brother. So my older brother works at Tasty Trade. I actually got him his job there, and then he's been working there, and then I left. So we both used to work at Tasty Trade, but my brother is still there. I am not. Experience teaches a lot. Yes, it does. Do you guys like these live streams? What do you like about my videos? What do you like about my YouTube videos that are on specific topics and it's like 10 minutes, 15 minutes, 20 minutes, and it's very focused, versus what do you like with the live streams? Because for me, I like the live streams because it allows me to interact with everybody, and I'm much more natural than I would be in one of my YouTube videos. In a lot of my old YouTube videos, I'm kind of cringeworthy just because I like the camera was too much in my face, or I just talked too fast and it just wasn't a good video. But then I've gotten a lot better in my newer videos. But then I like the live streams because I get to actually interact with you all and see the questions you ask, and then I get to answer them for everybody. And I get to go really deep on specific topics so you can really understand the things I'm thinking about. Whereas when I make a more educational YouTube video, I only really include the most important information. Olive oil, I will be doing more live streams. This is 2021. My goal is to do live streams every single week. So Guy, in the live streams, you show how to actually trade. Thank you. So I try to use my positions, and I know I haven't done any actual trades in the live streams yet, but in the future, there will be times where I'm going to actually place trades or an adjusted position while I'm doing the live stream. So it won't just be walking through concepts or walking through a position that I have, but in some of them, I plan to actually place trades. And so I hope that'll be helpful too for everybody. Triple Caution says, enjoy the live stream. Thank you. Do you set and take profit targets and stop losses for your positions? It depends. If I'm trading something with like a very laid out trading plan, such as a strategy in the S&P 500 that I trade from time to time, that has a very specific sizing requirement, and then profit target, and then also some guidelines for when to close the trade. So that's when I would actually have a profit target and a stop loss. For the most part, though, like in the positions that I've been trading recently, I haven't necessarily had stop losses because I talked about this earlier. Whenever I'm putting on a position such as a call purchase or a put purchase, generally I'll be completely okay with losing 100% of whatever that option value is. And so I won't necessarily have a stop loss. And then I also talked about earlier, if you're doing option purchases, the more you lose, then the less you have to lose, because you can only lose 100% of what you paid for an option. And so if you lose 75% of it, then you can only lose 25% more. And so then you can only lose 25% more, but you still have all of the upside potential if things turn around. And so the risk reward actually gets more favorable for holding the position as opposed to closing it. In terms of profit targets, I generally, with the positions I've been trading recently, it hasn't necessarily been like a dollar amount profit target, but I've had kind of stock price targets where if the stock price gets to a certain point, then I'll think about making an adjustment to this. But with something like Tesla, I've actually been a lot more hands off, and I haven't had like specific stock targets. I just kind of am reacting to what Tesla does. But like I said, I've done a lot of adjustments to the Tesla position to protect against a catastrophic loss to the downside. And so that's why I'm very relaxed with the position, and I'm not micromanaging every single movement. And I am bullish. I have to head out in a couple minutes here. I have to go to the gym in 4 or 5 minutes. Thoughts on Chamath's conversation on CNBC? I didn't see Chamath's conversation in regards to GME. I saw that he did get into GME. He bought call options in the February expiration, and he bought the 100 or 200 strike. So he definitely made a lot of money. Chamath is he's very aggressive. He's very adamant about his positions, and I think sometimes he can kind of come off a bit arrogant, but he has a lot of experience. He's done a lot of amazing things, so that's why he has a right to be. I did not see his conversation on CNBC though this morning about GME. I'll have to watch that. Thoughts on Tastyworks being bought? So Tastytrade, the umbrella company Tastytrade that owns Tastyworks, last week it was announced that they got bought for $1.1 billion, which I was extremely happy to hear that. And I got on the phone with Tony for a little bit to congratulate him, sent a message to Tom and Christy. I'm very happy for the Tastytrade squad, because the Tastytrade is a big part of my history. Like, I wouldn't be where I am right now if it wasn't for the opportunity that I had at Tastytrade. And so when they announced that they got bought out, I was super, super proud, very happy for them. Luckily, I'm doing well enough on my own where I'm not pissed off that I don't still work there and I missed out on the sale. But I'm very happy for them. Who bought them? A company called IG Group. I believe they are based in the UK, and I believe the plan is to basically expand the exposure of Tastytrade and Tastyworks much more than it is now. And I think the fact that they had a deal, like Tom and Christy would not sell, Tom and Scott, I should say, they wouldn't sell if they didn't think it was a good move for them. And so I think both companies are on the same page with the acquisition. All right. I got to go. But this was fun. some volatility in the markets again. Everyone keep an eye on Tesla. Let's see what Tesla does for earnings today. And I think Apple reports too. So we got Facebook, Apple, Tesla. It looks like it. All right, I'm going. Thanks everyone for tuning in, and I will see you in the next video or live stream, whatever it is.